To another round of investing talks. Today we have a very, very special guest with us. So if you've ever tried to, ask people about recommendations on how to learn about Warren Buffett's thoughts about investing, chances are that you've come across two resources most often. Of course, his annual letters to the shareholders, but the other resource that comes up most often is the essays of Warren Buffett, which have been edited and compiled and published by none other than our guest today, Larry Cunningham. He is also the author of this new upcoming book, Berkshire Beyond Buffett. And I'm just going to read a couple of lines from the foreword written by the legendary Tom Murphy. From afar, it may look like Berkshire's wide-ranging businesses are very different from one another. In fact, as Larry's book discusses, though they span industries different from one another, they are united by certain key values like managerial autonomy, entrepreneurship, frugality, and integrity. This is not happenstance. And to tell us more, Larry Cunningham.
Thank you very much. It's great to be here at Google's physical campus, having used its virtual assets for many years in my research, including for this book, Berkshire Beyond Buffett. And I'm grateful for the opportunity to discuss the book here with you as part of the book tour. I'm stopping mostly at universities across the country, but it's fitting to stop at Google as well, since it is in a way a center of learning. You can find more about the book tour and see if I'll be at a campus near you at the book's website, BerkshireBeyondBuffett.com. I've been studying Berkshire for 20 years and began writing about it in 1997 with the publication of the Essays of Warren Buffett. That grew out of a conference I organized where I first met Warren, Berkshire's chairman and CEO, who participated alongside his wife, Susan, and Berkshire's vice chairman, Charlie Munger. Back then, Berkshire Hathaway looked like a mutual fund, primarily owning stocks. And Warren Buffett was most famous as a stock picker. In earlier times, 80% of Berkshire's value was in common stocks and only 20% in operational businesses. Today, the mix is the other way around. 80% of Berkshire's value is in its 50 operating subsidiaries and only 20% in common stocks. Berkshire is today America's fifth largest corporation. Marking its 50th anniversary under Warren's leadership next year, it is a microcosm of corporate America. And its management principles are as impressive as Buffett's investment acumen, though they are far less appreciated. And now that Buffett is 54, however, people wonder what will happen to Berkshire when he's gone. Is there something so special about Buffett that his departure will spell Berkshire's demise? Most people think that there is. The New York Times last year portrayed Buffett as having a, quote, irreplaceable magic touch. The Economist this year lamented that Berkshire was down to, quote, playing out the last hand. Such views are paradoxical. Buffett's goal has been to build a lasting corporation. And yet even fans like these think the company cannot survive without him. So I researched this question, and I found the inverse to be true. That there's something so special about Berkshire that it can prosper even without Warren Buffett. I conclude that Buffett's greatest single achievement, more than vast fortune and generous philanthropy, is creating an organization larger than himself. True, Buffett may epitomize Berkshire, but it is far from a one-man show. First, there is a deep managerial bench, dozens of outstanding executives who helped build Berkshire. For my research, Buffett gave permission to them to help me, and they did. Many of them through interviews, surveys, and some even commented on the manuscript. A dozen are joining me on the book tour. It's an impressive group of people. A second group are Berkshire's directors, many who also helped me, like former Microsoft executive Charlotte Guyman, Warren's son Howard, and especially Tom Murphy, who built Capital Cities ABC into a media powerhouse. Earlier this year at Berkshire's annual meeting, I asked Warren who should write the foreword to the book. He instantly said, Tom Murphy. I asked why. He said Tom was his role model as a manager. Warren said he'd learned most of what he knows about management from Tom. These comments are noteworthy because this book is the first about Buffett as a manager, not as just an investor, and the first about Berkshire as a corporate entity, not just a portfolio of investments. And Tom's foreword, which was read to you a moment ago, captures an important theme of the book. And I've just put the same quote you just heard on the screen. Most of what I've learned about management, Warren said, I learned from Murph. I kick myself because I should have applied the lessons much earlier. Here's Tom's quote. From afar, it looks like Berkshire's businesses are very different from each other, but on close inspection, they're united by cultural bonds. This is the myopia that commentators suffer from. They concentrate and overemphasize the diversity of the businesses and underappreciate and sometimes overlook the cultural unity. Berkshire subsidiaries engage in a wide range of totally unrelated businesses: insurance and paint, energy and housing, transportation and food, jewelry, and pig feeding equipment. They vary in size, from fewer than 1,000 employees at many, like Benbridge Jeweler, to more than 30,000 at Fruit of the Loom. Annual revenues run between $300 million and $1 billion for most, and there are 8 whose revenues are so large that if stood alone, they'd be Fortune 500 companies. Profit margins are all over the place, stretching from 1% at McLean, the logistics supply chain manager, to 25% at BNSF Railway. Berkshire subsidiaries were acquired at prices all over the map. Way less than $1 billion for Justin Boots, $2 billion for Shaw Carpets, $9 billion for the Marmon Group, the conglomerate that Jay and Robert Pritzker built. They were acquired at varying multiples, from cheap bargains for the maker of Garanimals to princely premiums for the likes of BH Energy. And Berkshire subsidiaries are headquartered all over the map. Beneath that slide is a map of the United States of America that in this picture are not showing up, but they are in Massachusetts, North Carolina, Tennessee, California, Washington, all over more than half the states of the country. This diversity can be explained by the first sentence of my book. Berkshire Hathaway is an accident. It has never had a business plan. It doesn't believe in strategic plans. It is purely opportunistic, buying companies that fit its criteria and gel with its culture. Berkshire has disclosed what it seeks in its acquisitions since 1986, when it ran an ad in the Wall Street Journal stating its criteria. Those criteria have never changed, except for size, which went from $5 million in annual earnings back then to $75 million today. Proven profitability, good unleveraged returns on equity, management in place, basic businesses, and a fair price. Berkshire often cites Berkshire culture as part of what will enable it to prosper without him. But he's never said exactly what that culture is or explained where it comes from. That's where I come in. By defining and illustrating Berkshire culture, my book contends that this culture is Berkshire's most valuable and durable competitive advantage, which will contribute to its business longevity long after the Warren Buffett era. Intuitively, people don't expect conglomerates, vast and diverse, to have discernible corporate cultures. But Berkshire has a distinctive one, based on a core set of shared values. In my research, I probed Berkshire's 50 main subsidiaries, seeking to identify their corporate cultures, looking at the practices and beliefs that define them through legends, lore, and the trials of transitions. I then scrutinized these profiles, and as I did, a pattern emerged. I saw recurring traits across all of them, 9 altogether, all being intangible traits that the subsidiaries turn into economic gain. In the book, by offering individual snapshots of these 50 companies organized around those 9 values, the book presents a portrait of the whole. Let me highlight a few of these traits. Berkshire subs tend to be thrifty. Some say frugal, cheap, even tightwads. Geico is a great example. Its business model is to be the low-cost supplier of car insurance, a standardized product that law requires people to have and few people wish to splurge on. Geico turns those conditions into a competitive advantage. It doesn't pocket all the savings from its thrift, but passes most on to customers. In fact, it caps its underwriting profit at 4%. If profits would be more than that, it lowers prices, delivering value to its customers. This, of course, is not altruism. That model grows market share, increases total premiums, and enlarges aggregate profits. All Berkshire subsidiaries embrace the golden rule. Do unto others as you would have them do unto you. Take Clayton Homes. It is a leading lender to lower income families in the United States and also manufactures the trailer homes that many of that cohort buy. It always looks out for its customers. Here's an example of how Jim Clayton, who founded the company, treated his customers. He sat down with them and determined what their income was and their resources, and then worked backwards to build homes and lend money to meet their budgets. Integrity like this pays. Amid the financial crisis of 2008, Clayton's peers were uncovered lending to sketchy buyers who they lured in with low teaser interest rates. Those companies faltered and many cratered during the financial crisis. That enabled Clayton to prosper, moving it from 4th in its industry to number 1. Integrity is so central at Berkshire that managers even remotely threatening it are soon let go. Whether David Sokol, once considered a probable successor to Buffett, who was alleged to have engaged in insider trading, or successive managers at Benjamin Moore, who prepared to market paint through big box retailers in violation of a commitment Berkshire had made to its local distributor network. Berkshire subs are earnest. They consider keeping a promise to be sacrosanct. And they turn that moral conviction into economic gain. Examples are Berkshire's other 2 big insurance companies, National Indemnity, NICO, and Gen Re. They insure large and unusual risks, some spanning decades. These features render their word in an insurance policy a precious asset. For instance, earlier this year, NICO insured an offer by Quicken to pay $1 billion to anyone correctly predicting the men's NCAA 64 tournament bracket, the odds of which are something like 1 in 126 billion. If you pick it, Quicken probably doesn't have the $1 billion to pay, but NICO does, and it will pay up. The NICO Gen Re business model differs from Geico's. They don't put the money in the pockets of customers. They pocket the profit. They charge premiums for the kind of special commitments that these high-end products entail. So Berkshire thus generates value from its high-end businesses where customers pay a premium for earnestness. People prize autonomy, and complex businesses gain value from hands-off oversight. Berkshire is thoroughly decentralized, with subsidiary CEOs having virtually unbridled discretion over all operational and strategic decisions. Autonomy starts at the top and trickles down throughout the subsidiaries, and at most subsidiaries tends to trickle down across them. A conspicuous example is the Pampered Chef, which sells its kitchen gadgetry through 70,000 independent distributors, all of whom call their own shots. Every CEO I interviewed for the book emphasized the value of autonomy at Berkshire. Jim Weber, the CEO of Brooks, the running shoe company, put it this way in my interview with him. Quote, "I've never had so much autonomy in my career and never felt so accountable." Tom Menente, the CEO of MyTech, the construction material firm, spoke of the triple-down rationale in my interview with him. Quote, "Berkshire and Buffett give me total autonomy. Being treated that way makes it easy for me to treat our managers the same way." In chapter 16, I conclude with this sentence, quote, "Berkshire's secret to managing a large, complicated organization is to manage parsimoniously, as little as possible." And finally, Buffett is well known as a long-term investor. But a more profound point about time at Berkshire is that its horizon is forever. Unique among its rivals in the acquisition market, Berkshire has not sold a subsidiary in 40 years. That sense of permanence has great economic value, whether to family businesses wanting a legacy or entrepreneurs wanting security. The most dramatic are subsidiaries I call corporate orphans, those that were owned serially by leveraged buyout operators, private equity firms, or bankruptcy trustees. The experience can make managers ache for a permanent home. For example, the recreational vehicle maker now called Forest River was owned by 3 different LBO operators in a row before being acquired by its current CEO, Pete Legal. It raised funds in yet another LBO, borrowed very costly debt. The LBO operators micromanaged Pete, and the company soon sailed into bankruptcy. Pete bought most of the assets out of bankruptcy, rebuilt the company, positioned it as number 1 in the industry, and then sold it to Berkshire, where he continues to expand without debt, with total autonomy, and a permanent home. So permanence is Berkshire's bedrock. That is reason to believe in Berkshire's future after Warren Buffett is gone. Now, the Warren Buffett era continues, of course, and may continue for another decade or 2, as Warren is in very good health. Still, whenever it ends, as I write in the book's closing passages, quote, "While it's hard to imagine Berkshire without Buffett, it seems wiser to believe in Berkshire Beyond Buffett, an institution that transcends the man and will be his legacy." I thank you very much for your attention. I'd be delighted to have questions from the audience. Thank you very much. Thanks a lot.
I know that, at least in the past, Warren Buffett has kind of tended to avoid tech companies in his investments, kind of saying he doesn't understand the industry, it's under a lot of change. Do you foresee that changing in the Berkshire Beyond Buffett?
It might change a little. I mean, the lack of understanding is a relatively personal quality that Buffett has. And so if his successor were more tech savvy and able to understand it, there's a great possibility that you would see some tech companies within the Berkshire family. The piece about rapidity of change, though, is a question mark, right? Berkshire prefers rudimentary businesses, those that have been around a long time, that change relatively little. And so if the successor were to adhere to that aspect of the rationale, I wouldn't expect to see a great many come into the Berkshire fold. So we'll have to see, but certainly that the first half is somewhat of an idiosyncratic position rather than an institutional position. But the feature, the need for focusing on rudimentary businesses, I think will provide a continuing filter.
As you were closing this, you mentioned there was that person who did the homes and then sold it. It came out of LBO 3 times, and then they ended up selling it. Yeah, that one, Forest River.
Yeah.
Right. So after he made it profitable, what was the benefit of going to Berkshire after that?
Capital, right? In order to grow this company, it's a capital-intensive operation. It's a manufacturing operations, and he's got plants in a variety of states and distribution centers and so on. So in order to grow, he needed capital. And his personal experience with the LBO and the company's experience with LBOs before him showed that borrowing large amounts of capital can be dangerous. And so he did not want to go to the LBO route to get capital. I left out that I tell in the book, he had also taken the company public at one point to gain capital, which also provided a bit of a bruising experience. Short-term pressure to deliver profits this quarter and this half year and so on were difficult to sustain in the recreational vehicle manufacturing space. So this fellow Pete, he just been bruised, borrowing money, raising equity in the public capital markets, and so once he righted the ship, he needed more capital, and Berkshire was a perfect place for him because there's plenty of capital, and as long as you're generating good returns on capital, you're likely to get plenty more, and he has done a terrific job in doing that. And I mean, his press release when he announced that transaction emphasized that this company will no longer be borrowing money. So it's all Berkshire capital, and he's just doing a phenomenal job. And he's just one example. There are 7 what I call corporate orphans that I feature in that chapter, and they pivot around that longing for there a way to generate capital without the shackles of either micromanagement or short-termism. Berkshire is one place.
Recently, Berkshire made some big investments in BYD in China and POSCO in South Korea, and I was wondering, on a going forward basis, do you see more of that? And how do they, since culture is such a big part of the business, how do they evaluate the management with such different cultural situations?
Excellent question, thanks. I'd first draw a distinction between common stock investments like those 2 that you mentioned, where Berkshire buys a minority interest and doesn't have the full control over those enterprises. And on the other hand, the subsidiaries that it does fully own and fully control. So the commitment of Permanence is to those companies that it fully controls and fully owns. So when it bought See's Candy or Forest River or Geico, the commitment is we will always own you and never sell you. You with me? So those minority common stock positions, Berkshire and Buffett would prefer to own them forever, but there's no commitment of that sort. So if they deteriorate economically, culturally, or for other reasons, they're sold. And that explains the subsidiaries. All but one are American companies based in America with their managerial affinity to the things Berkshire has been doing for a long time and understands. The one exception is ISCAR, short for Israeli Carbide, which is based in Israel with operations all over the world. And it's actually, even though it's a foreign company, it has a lot in common with Berkshire. It's kind of a large conglomerate, a network of different companies. But when they went and bought that, it was a very slow transaction for Berkshire because he, Buffett, and his inner circle had to learn about Israel, management practice there, tax issues. So it took a lot longer. So with that backdrop, I don't expect many immediate additional acquisitions abroad, but I do predict in the book that we will see that gradually in the coming years. But I think that, in other words, the Berkshire model is scalable to the world, but I think it would take longer to do that than it's taken to spread across the United States.
Hello. One of my concerns for Berkshire is that what if the successor engage in empire building, so that if they make some big major but mistaken acquisition, then Berkshire is going to underperform the index. So what's your take on that?
Yeah, I think so. I think the first thing to appreciate about mistakes is that Berkshire has made a lot of them in its history. And the first thing that the successor in his community will need to remember is that they're going to make them again. You with me? So people should avoid, I think that one big risk for Berkshire Beyond Buffett is a nostalgia trap. When people think, oh, Berkshire was so wonderful before and now there are mistakes being made. So mistakes will be made, and I think people should accept that the CEO will make mistakes. If the mistake she or he makes is a mistake of violating traditional Berkshire culture, undermining some of these principles, then I think there would be serious cause for concern. For example, if a successor were to say, we are not going to continue to own Forest River. We've had enough of it, we're going to sell it. If they did that, that's more than a mistake. That would be a breach, I think, of Berkshire culture. And if that kind of decision were made, the CEO began selling off subsidiaries, that would destroy Berkshire. It would undermine at least a very important fundamental principle. I don't think a person will do that. There may be some pressure. Activist shareholders might pressure a successor to sell this company, that company, or the other one to get the cash rather than having these companies sit inside the broad conglomerate. I don't think the activist shareholders will succeed in that kind of campaign, however, because all the CEOs of Berkshire companies understand these values, buy into them, and one of them who's leading the company will sustain them. Moreover, the board of directors that I referred to understand these values, appreciate their importance, and will likely try to enforce them. Indeed, the chairman of the board is very likely to be Warren's son, Howard, whose job, Warren has said, will be to remind everyone, if needed, of Berkshire culture. So there is some risk there, but I think the plan that's in place is the best reasonably possible plan to protect against it.
I have a three-part question. Given that the success of Berkshire going forward is mostly the operational companies and not the investments, what do you think the investment portfolio plays a role going forward? Specifically, Ted and Todd's role going forward. How important will it be?
Okay. Can I take that one first? Sure. That's great. So I think it's true that in terms of Berkshire overall, the investment portfolio is now 20% of the overall value, and so within that broad company, it's less important than it's ever been. I should stress, it's still $120 billion, so it's not like you can just ignore it. It's a lot of money. Ted Weschler and Todd Coombs have been successful investors on their own before joining Berkshire 5 or 7 years ago. They have now continued to show their investment prowess, sometimes beating Warren Buffett in those years. So I've got a lot of confidence in those fellows, and obviously Warren does and the board does. I think their job, the hardest thing that they will have to deal with is the anchor of size. It's very difficult with that amount of money to pick stocks and continue to outperform the market. Moreover, Berkshire's investment portfolio is highly concentrated. Of that 120 billion odd, 70% of it is in just 7 companies. American Express, Wells Fargo, IBM, Coca-Cola, ExxonMobil. Just 7 companies make up 70% of the portfolio. Now, in the next 5, 10, or 15 years, the economic characteristics of one or more of those may deteriorate, and it may be time to sell. Whoever has to make that decision is going to, that's a huge challenge to decide, okay, we're selling Coca-Cola. That's going to be a very hard decision to make. Moreover, having made it, then they have to figure out what to do with 10, 15, or $20 billion in one fell swoop. It's very rare to find acquisition opportunities of that scale. as Berkshire repeatedly shows. It's eager to find such things that they simply don't come up very often. So Todd, Ted, or whomever is running that portfolio is going to have a very hard job of deciding what to do. Probably it will mean buying a larger number of smaller stakes. In other words, making it look more and more like the market. So that, I think Tad and Tad, they will do fine, but it's going to be a very different job than the job Warren has had, and there are going to be some heavy challenges. And what's this?
I think part of the question's answered, but I'll ask it anyways. How do you compare Ted and Todd's performance so far to, say, Warren Buffett's investing prowess about 20, 25 years ago? So I think both of them are managing, what, $7 or $10 billion together. I'm thinking like if you went back to 70s or 80s when Warren was managing that portfolio, how do you compare the two? Do you have any insights or additional thoughts on?
No, I mean, they are experienced investors with a good track record. At Berkshire, they, I think, were responsible for selecting DirecTV, which had a good run and then a big payout, and also for DaVita Health, which is developing kidney dialysis equipment, and both of them are very successful. So it's hard to compare. Are those like Coca-Cola or like Cap Cities, ABC? I don't know. It's different eras. It's different types of businesses and so on. But the track record is strong. So, there was a joke floating around on Twitter this morning about this person's the Warren Buffett of Canada, and this person's the Warren Buffett of China, and this person's the Warren Buffett of Australia. And someone from MarketWatch asked me, is it good to say that you're the Warren Buffett from this place and that place and the other place? And my response, thanks to my wife, was, there's only one Warren Buffett. As good as Tad and Ted are, they're not Warren. They're not going to be Warren, but I think they'll do just fine for themselves.
What do you think about this idea that software is eating the world, and that basically a lot of businesses that have been sort of immune to technological change for a time basically get more and more software that will determine their eventual profit margin? So is there, like, 'cause when I look at the list of the companies, they seem sort of the ones that are sort of a little bit insulated maybe right now, but down the road, do you think that's going to change?
Yeah, I mean, every competitor faces risks of technological change and disruption and even obsolescence. And that's been true throughout history, and we probably are living in a period of particularly rapid change. So that even companies in Berkshire's family face this. See's Candies, for example, is an excellent confectioner with a terrific product and brand name, but it's been kind of regional. And they have not been able to expand it despite the internet. And they need to, and they are working on that, but it's going slowly. The Pampered Chef, to which I referred earlier, sells its products through these 70,000 independent distributors. Traditionally, these people have parties at their homes and invite friends and neighbors to test out the stuff and use it. And it's a quaint, delightful, wonderful business model that was very successful in the 90s, but is less successful now. And they need to figure out how to navigate the current environment. Berkshire has acquired a lot of newspapers just in the last 3 or 4 years, a business that is rapidly changing. So many Berkshire companies face this kind of challenge. And what's special about Berkshire is that it sticks with them and attempts to help ride out the onslaught and adapt to it and change and evolve rather than just sell it. So as long as other members of the family maintain their competitive advantages and generate capital to support those that need it, the whole can be sustained. So, and the idea of keeping even those that are struggling is so fundamental to the company's DNA and its success that anybody who takes over the CEO job will have to see that.
So during the financial crisis, AIG was destroyed just because a small part of the company, right? I think it was the derivative department. So, do you see that there might be something like that in Berkshire? Yeah. So that it may have some major mistakes, so that it would just destroy all of the shareholder value. Yeah.
Right, yeah, that's right. It was the financial products division at AIG that had expanded a portfolio of credit default swaps that turned out to be toxic. And Ben Bernanke, the chairman of the Federal Reserve at the time, described the company as being an insurance company with a hedge fund on top. That FP division had absorbed enormous risks and became really a cancer that threatened to metastasize across the company until the great surgeons at the federal government did serious surgery and saved the victim in a certain way. I wrote a book about that with the former chairman of the company and attribute that to a problem of internal control at the company, that group should not have been able to do that. There should have been monitoring and oversight of that group that had simply disappeared. And so it's a great and important question. Every company needs to have some mechanism to identify potential rogues in their midst to eliminate that kind of problem. And I do think Berkshire has that. It's not a traditional internal control structure with lots of layers of oversight and thick reporting protocols and second guessing and so on that you would see today at AIG or at IBM or probably even at Google. But instead, this approach, I call a trust-based approach to corporate governance, relies heavily on that autonomy principle, so that at Berkshire headquarters, there is no direct mechanism to monitor, let's say, the Cyprus Insurance Company, and what exactly are they underwriting? Or even for that matter, Gen Ray. Gen Ray got into considerable difficulty shortly after Berkshire acquired it in the late 90s because it had underwritten a concentrated level of super catastrophic risk of biological, chemical, and nuclear disaster. And after 9/11, it faced insolvency, and if Berkshire hadn't acquired it a couple years before, it would have gone under. Berkshire put into place senior management who vowed to correct that problem, eliminate those kinds of concentrated risks, and maintain a culture in which that will not be permitted to happen again. So all across Berkshire, that kind of autonomy, trust is baked into the company. A rogue can show up anywhere, but I think I am convinced that the governance, the control model at Berkshire, this trust-based model, does work at the company. So I have a very low level of concern that you'd see a sort of a financial products at Berkshire, financial products division like AIG had at Berkshire.
So you mentioned the importance of culture and the companies that Berkshire acquires. Does Berkshire look for companies that already bring the same cultural values to it, or do the subsidiaries evolve to that same point? And how does a large company like a Berkshire preserve its culture?
Yeah, that's an excellent question. My answer is that it's iterative. That when Berkshire scouts for acquisitions or when acquisition proposals are presented to it, primarily to Warren, he has a sense that the company needs to be frugal, earnest, entrepreneurial, prepared for autonomy, and interested in the long term. So it's a mental checklist that he has that companies that fit the Berkshire mold will also have. Then when they join the Berkshire family, those values get reinforced. And so the family is, in that way, self-sustaining. And that it's sui generis in the sense of being almost automatic. Sure, people need to buy into the principles and need to reinforce them through their words and actions, but I think you see that in abundance. But it could unravel. If the wrong leadership assumed control and decided that these values were not important anymore and began to micromanage the CEOs, to sell subsidiaries, or to skate close to the edge of integrity and so on, then the culture could unwind and you'd have simply another conglomerate like Litton Industries or Gulf and Western or United Technologies or General Electric, what have you, and what is special about Berkshire would dissolve.
So you've written about Ben Graham, the essays of Warren Buffett, and then the AIG and this book. Through all your years of interacting with everyone, what would you say are one thing you learned that you would like to share with us about investing, and then one thing that you learned that could apply to just life in general?
Well, I'll take the second one first because it's easier. It's integrity. Life in general. I mean, just being honest, being forthright, keeping your word, treating your promises as sacrosanct, staying in the middle of the playing field, to use an athletic analogy, avoiding skating on the edge of thin ice. I like Buffett's admonition on this point that he came up with in the late 1980s Solomon Brothers bond trading scandal. That was an investment banking firm brought to its knees by a few rogue traders who tried to corner the U.S. Treasury bond market, and it threatened the life of the firm. And in trying to rehabilitate this institution, which had been a venerable banking house, the board asked Warren, who had bought stock in the company, to become chairman. And he stepped into that role with great turmoil, and the first thing he did was clean out the top management ranks and install 3 of his own chosen executives to be CEO, general counsel, and CFO. And these were people with exemplary reputations for ethical business leadership. And he then stood up and told a press gathering and wrote a memo to the workers that said, lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I'll be ruthless. I mean, I'm getting chills just saying that. Did you get chills? I mean, he said, and his test for that, in case you needed it, was in any action you're about to take, any insurance policy you're going to underwrite, any bond trade you're going to do, any leasing transaction, any sale of a mobile home, he said, think about that decision, your activity, being written up by a journalist on the front page, or now your web page, of your hometown paper, by a smart journalist. And would you do it? Knowing all your friends and neighbors would know this is what you did. That's not a pretty good test. So that's my answer to your second question. Life lessons to me, lessons I'd like to share with my children. Integrity is really number one. I like being thrifty, and I like autonomy, and I like permanence. They're all very important, but you had to boil it down. I think integrity is number one. Investing lessons, I admire the tradition of value investing begun by Ben Graham, sustained by and modified by the likes of Phil Fisher, who wrote the great book Common Stocks and Uncommon Profits, and by Charlie Munger, Warren's partner since the 70s or 60s, who and Warren himself, who emphasize fundamental substantive analysis of particular positions. It's hard homework. Not easy to do, requires research and effort, but I admire that tradition. And so I guess the one thing I learned from that is that in investing is a significant undertaking, and if you're not prepared for it, it's okay. But it's just then the best thing to do with your personal excess capital is to buy an index fund, like the ones run by Vanguard or Fidelity, so that you don't really have to do the work. You'll enjoy the market return, good and bad overall, long term probably good. But if you're going to do tailored investing, then I like the value investing model, the fundamental substantive model. In comparison, say, with trying to track patterns in performance over time, or trying to time the market on a daily basis, getting in and out at the right times, and other techniques that they don't appeal to me. So I've been a great devotee of that Graham, Fisher, Buffett, Munger crowd.
Thank you very much for this fascinating talk.